Great. Well, just to get some introductory thoughts and observations from the panel, if each one of you would share a couple of minutes maybe of your thoughts and observations on the value of the CAT fund as it exists today, specifically as a financial stabilizing force for the state. And that's like a couple of minutes as in two. Jack.
2 minutes, okay. I think the CAT fund was actually created for that purpose, is to create stability in the marketplace, not only insurance market, but the economy in Florida as well. And I think today it does that. It's been doing that for about 22 years now. It's funded in a certain way that is different from private reinsurance. I always say every opportunity, we're not private reinsurance. We're a state tax-exempt trust fund. In order to be a state tax-exempt trust fund, we had to get a private letter ruling from the IRS. And one of the requirements, the way the CAT fund was structured, is it be set up as a kind of like a taxing entity. So when you hear the word hurricane taxes, that comes about through emergency assessments that finance bonding. And bonding is the way that we create the capacity. So the risk, of course, is in whether we can do that or not, but that's basically our role and our mission.
That's good. You did good. Brad, if you could.
You're going to have to rein me in once I get started on this one. So I'm old enough that I remember the creation of the CAT fund, and I remember the original CAT fund study commission that the legislature launched with then Insurance Commissioner Bill Nelson. So the CAT fund has taken many different forms over the years, and of course the form that we think was the worst version was the Charlie Crist created form in 2007. And so what's important to understand is that the CAT fund was created at a time in which reinsurance market conditions were sort of a snapshot at time. As Barry Gilway said, we're in a completely different world now with unlimited reinsurance capacity available for Florida. And in terms of expectations, that's the new long range or long-term expectation for the Florida market. So it's an opportunity to rethink business strategies, government strategies, and I think Barry and the citizens' experience shows the way in what could be done. And the experience that Barry has is being replicated in other jurisdictions around the country and also around the world. So the CAT fund as it's structured today crowds out private sector capacity. We think that's a bad thing. The cost to taxpayers of crowding out private sector capacity is you put yourselves on risk to pay off bond debt when it is issued. Given 9 years of favorable experience in Florida, cash has accumulated in the CAT fund. This is an unusual 9-year period. It's not been replicated before in recorded history in Florida. So Florida will revert to the mean. There'll be additional storms. Additional storms will eat up cash. Additional storms will lead to bond debt being issued and lead to hurricane taxes. And now we have an opportunity to take action with legislative change to right-size the fund and minimize the issuance of that debt and minimize hurricane taxes. So that's an opportunity that's presented today to legislators and to business leaders in Florida.
I largely agree with Brad's points. I'm going to take a position that the CAT fund has never been a force of stability. The CAT fund socializes a significant portion of the homeowner's risk in the state of Florida. And by having people who aren't at risk paying the full price of the property that they own and the risk that they present, the economic signals about risk are suppressed. So what happens? Those people pay less than they should. The question is that something that's positive or negative? I think it's negative, because I think what happens is those people do not build properly, they don't pay the right price for their property, they'll pay more probably than they should have, because the amount of Their insurance, their monthly costs would be greater if their insurance prices were greater. And then the cat fund, because it issues so much debt, or has the capacity to issue so much debt, is a problem. From 94 to 2005, the cat fund did provide an element of price stability in the insurance market. But in 2004, 2005, the cash went away and it had to bond. 2007 was a period of disruptive politics. The cat fund is capable, because it is a political animal, is capable of being disrupted by political influences, notwithstanding the good stewardship of Jack Nicholson. The cat fund has to issue currently $17 billion year in and year out, whether it has the money, whether it thinks it can pay for the losses or not. That creates instability. Assuming the cat fund can pay in a year in which it has to borrow money is a problem. The mere fact that it issues debt creates instability. There was a recent study about 2 years ago by the Bank of International Settlements, which compared economies that had catastrophes who transferred risk and those that did not. Those that internalized risk, like the state of Florida does, they found that their economies were dragged down by the debt, and they posited the fact that those economies might never recover to the point where they were pre-catastrophe, whereas those that transferred risk had a tremendous economic stimulus by capital coming in and helping to rebuild without the negative consequences of debt. And aside from the fact that there are all those negative externalities, I think if you focus, like Florida seems to want to do, only on insurance prices and ignore all their free market principles that they believe of and other consequences, if you focus solely on insurance prices, I would say the cat fund has provided a degree of stability over time.
Thank you. As a second question, I want to dig a little bit deeper, and I think it's a little tougher question. In light of the tough storms that we endured several years ago, 2004, 2005 season, and in light of the financial meltdown we sort of faced with the rest of the world, with only maybe a couple years of breather between those storms and that financial meltdown, 2 or 3 years between, but having had, as you said, 9 years with no hurricane landfall in that same mix, and certainly that having affected the last 4 or 5 years of cat fund performance, what is each one of your views on what the state of Florida, with the cat fund, first of all, and the state of, not the cat fund, I'm going to ask that question in a second. What's your opinion on what the state of Florida would look like had the cat fund not been here during that entire period of time? So, when we're really looking at the last 10 years, how do you think Florida would look differently without the cat fund? Brad?
So it all depends on the snapshot of time and your loss experience. Again, you all lived through 2004 and 2005, which is a terrible time for Floridians, who experienced 7 hurricanes in a 2-year period. So during that time, the cat fund's cash was exhausted. If that and bonds were issued and the bonds were just paid off, I think in the last calendar year that just closed was the end of the bond debt financing period. If the normal Florida hurricane pattern had continued between 2005 and 2014, there have been many more bond issuances that would have occurred during that time period. And there was that time period included the financial crisis, which meant that the ability to bond had basically shut down. So the cat fund was selling a promise to pay without the financial capability of fulfilling that promise. And the Florida seeding insurers were forced to take on that cost of an unfunded payment that might come from the cat fund in the event of a continuation of a normal hurricane season. So it all depends on the snapshot of time. So the ideal would be to right-size the cat fund in such a way that it does act as a financial stabilizer, that it can annually meet its obligation to pay its clients here in Florida. And we would look to that as sort of a 3 to 5 year plan. Can you design the cat fund so looking over a 3 to 5 year period, there's a stable, well-funded layer of catastrophe protection available to Florida cedents. That truly would be the best way to create the cat fund as a shock absorber.
Okay, and since actually Brad did answer without my even asking it, the sort of tag-along question I wanted to ask, which was not only what would we have looked like without the cat fund, but had the last 5 years looked differently in terms of storms, how would things for the state look differently? Then I would ask both of the two remaining gentlemen to kind of address that as well. So Dennis, if you would.
But I think Florida could have done without the cat fund almost from its beginning. The reinsurance market had largely recovered or completely recovered, depending upon who you talk to, by the time the cat fund actually started issuing capacity. In any event, it's a certainty that the cat fund could have been phased out early in its existence, like the Hawaiian Hurricane Relief Fund was. From 2004 to 2005, there probably wouldn't have been a significant difference because there was no debt issued into it, there were no assessments. 2006 was a difficult year for the Florida market, and that's because 2004 and 2005 were a surprise. Demand was driven up exponentially because the rating agencies, the models changed, the rating agencies demanded more capacity by insurers and reinsurers, so that way they could, instead of meeting a 1 in 100, they needed to meet a 1 in 250 and a 1 in 100 or a 1 in 200 earthquake at the same time as hurricanes or multiple hurricanes. So the rating agencies made a significant difference in how companies approached their risk management and the market. And management themselves had problems with their performance and said, how can we be better? So the combination of all those things drove the demand for reinsurance exponential. I think if the cat fund did not exist in 2006, there probably would not have been much of a difference because the reinsurance market had provided and allocated capacity to the state of Florida. It would have covered the $17 billion that the cat fund was issuing at that time, or nearly $17 billion, I believe it was. And the problem that happened in 2006 is that suddenly people wanted a heck of a lot more reinsurance than was previously allocated. The reinsurance market raised, according to the RAA count, about $43 billion between the ILS and reinsurance markets, but it wasn't able to deploy it quickly. And that led us to 2007. What would have happened in 2007 without a cat fund? Your guess is as good as mine. It was an ugly political time with the pitchforks and Steve Geller running around. So that by itself can be frightening, as some of us know. And I think that Florida may have done something, but if it believed in the free market and actually let the free market operate, perhaps they would have reacted differently in 2007, but that didn't happen. In the financial crisis, I don't think there would have been much of a difference than what happened. The insurance and reinsurance market is not systemically important the way banks were. The insurance and reinsurance markets, because we invest and pay our losses based upon catastrophes or other events and not on demand, like people would have runs on the bank, which occurred. Those are issues that make us different, to make us less systemic. Plus, insurers and reinsurers don't have the leverage issues that banks had. We muddled through in 2008, 2009. We would have muddled through in any event. Now, record capacity, plenty of capacity sitting on the sidelines, as Barry discussed earlier. You go out and want reinsurance, people are going to sit there and compete for your business. And if more reinsurance is needed or more capacity is needed, we have now gotten to the point we can just about instantaneously deploy it. So I think in the current world, if we didn't have the cat fund, we would probably, there may be some hardening of the market in the future. I don't think that's beyond the realm of business, and my members would probably like to be able to have some pricing power at some point in the future. But I don't think, because of the speed at which capital could come in, that we'll have the spikes that we had in the past. With regard to the past 5 years, if there were a number of catastrophes and hurricanes had hit, as Brad said, the CAT fund probably would have run out of money at some point, or potentially could have run out of money. It would have had to borrow and would be assessing businesses and people in this room. As I said before, debt is not good. Reinsurers don't have the ability to assess, so that's a good thing. Reinsurers expect there to be catastrophes. 2011 was a record year for worldwide capacities, and reinsurers continued to play in the market, and they will continue to play in the market. That's the business they're in. That's what they'll do. So the question is, if we had those storms, and those storms were within the range of expected possibilities, I don't think the reinsurance market or the insurance market would look substantially different than it does today.
Jack?
Well, I'm not quite ready to throw out the baby with the bathwater when I'm the baby in the bathwater. Still need a job for a couple of years, contrary. But, it's interesting because it's a hypothetical question, and, it's like, it all depends on what happened in the last 22 years. We know what happened. Hindsight's 20/20. I mean, we were stupid to buy insurance for the last 9 years. We didn't have any hurricanes or anything. So you say, well, why did you even buy reinsurance? It's crazy. Why buy CAT fund? I mean, you'd never want to do that. So if you know the future, it's pretty easy to make a decision. That's the problem. We don't know the future. And the CAT fund was created because of a political necessity. So these two guys right here, they're ignoring the politics of the deal. But the CAT fund passed the legislature all but one vote in 1993, November special legislative session. And unfortunately, House Bill 1A passed with the exception of two votes. So all of that was driven by politics and people wanting to reduce rates in 2006 and 7. But in 1993, it was different. It was the cancellation of policies, the threatened cancellation of upwards of 600,000, 700,000 policies that the state could not tolerate. Thanks to Tom Gallagher over there. I can see him smiling because he's saying Jack's getting this one right. But it was guys like him that recognized that problem and did a lot of things to keep the market stable. So it's probably likely to say you would not have had a stable market for the last 22 years, regardless of what these two guys are saying. And yes, I will say, I will admit, I'm probably the first one that pointed out the issues of the CAT fund in terms of being able to manage our risk and things like that. But I want to make sure that we understand something clearly. The CAT fund would have never been created without the volatility of the reinsurance market. And you've got to understand, insurance markets and reinsurance markets are always volatile. That's what's called an underwriting cycle, feast and famine. They'll cut their throats with low prices in a heartbeat, and then they'll jack up the rates and upset consumers the next year. And we'll have all kinds of legislative outbursts all over the country when all that happens. That will continue to happen. There's nothing that has changed. The thing that drives the CAT fund's instability is financial markets. And we do have certain capabilities of managing our risk within the statute of Florida, things that we can do, pre-event notes, things like that we've done, purchase of reinsurance, purchase of CAT bonds, but a lot of things are laid out in the statute in order to maximize the capacity of the CAT fund. So even when we try to even think about those things, we have even some of the people out here in this audience complaining because we're going to cause rates to go up. And if an insurance company needs its rates to go up, even up to 15%, it doesn't even have to have a public hearing on that. But if it's got a justifiable reason because its financial capabilities, the insurance regulator, Kevin McCarty, generally allows that to happen with proper justification. So it's no different, from the CAT fund standpoint. I feel frustrated a lot of times because I think there's a lot of things that we can be doing, both legislatively and administratively, to strengthen the CAT fund's financial capability, and all the things that these guys have talked about can be managed. In the reinsurance market, this instability comes about because of one thing, that's catastrophes. They happen at the most inappropriate time when you don't expect them. You're flush with cash today, but if there were a big tsunami or a $300 billion loss somewhere around the world, which could easily happen, I mean, we don't want to think about that because we haven't had anything that bad. We didn't have anything that bad before Hurricane Andrew struck. We didn't have anything that bad before Katrina struck or 9/11. So we have a very complex world that is becoming less and less safe to live in every day with terrorist attacks and possible, countries getting nuclear weapons and everything else that goes along, and the buildup in populated areas that are subject to catastrophes. So it's the volatility coming both from the financial markets that certainly affects the cat fund's ability. We've got certain tools to do something about that. And it's also the volatility with the private markets that causes problems and upsets the public, whether it's capacity problems following Hurricane Andrew or whether it's rate problems following the 8 storms in 04 and 05. So I don't know. I think that we've done our job. We've had to issue debt one time in 22 years, assessment of 1.3% that was terminated 18 months early. So I think we've done our role. We were lucky. I'm not going to paper over that. We were lucky. Things could have been worse. So I think there's where both points of view have to look at things. You have to look at what did you learn, although it didn't happen. What did you learn that you could do differently in the future because it might happen. So I think that's how we have to look at the cat fund and managing the cat fund going forward. And the same thing with the reinsurance industry. You've got a glut of capital now, a lot of competition from the capital markets. Is that permanent capacity? Maybe, maybe not. We've got record low interest rates right now. Pension funds looking for alternative sources of investment to stabilize their portfolios and diversify. If that continues to happen, great. If it doesn't, then things will change. So I don't know. I can't answer for sure what would have happened, but I can just say what did happen is we've had a fairly stable market for the last 22 years.
Lauren, can I just add to something Jack said? Sure. So I certainly agree that Jack and Tom Gallagher were excellent stewards. Tom was an excellent steward in his role as CFO and insurance regulator, and Jack's been an excellent steward of the cat fund. So I hope nothing I've said implies some disagreement with the decisions that these wise policymakers and administrators made. But what is different going forward is the insurance cycle has now changed for the long term. So when there's $3 trillion in pension assets around the world looking to take on cat risk, and they take on 1%, that's $300 billion. That is almost equivalent to the entire amount of property catastrophe reinsurance purchased in the world today. So currently, pension funds have put about $62 billion, or 18% of the market roughly, into this risk. The expectation is that will rise to $150 billion by the end of this decade. And these are not untested transactions. These players now increasing their participation have been testing this market since Hurricane Andrew. They've been testing it for more than 20 years. They've grown comfortable with the risk, and they're pricing the risk in a way fundamentally different than traditional reinsurance that priced the risk. And that's why the market has changed. So going forward, the capital has converged. The reinsurers are also administering pools of funds provided by pension funds. And the pension funds are taking on risk directly, either through their collateralized reinsurers or through ILS catastrophe bonds. So the playing field has shifted, and that's really the main point I want to get across is that past is not prologue for Florida, and it will not always be a rosy picture. But if there's $150 billion extra of capital available to take on catastrophe risk, even when that market contracts a little bit, it contracts to a base that is fundamentally bigger than it ever was before. And that's why the dynamic has changed. So the continuing willingness of pension funds to take on risk has dramatically changed the tops of the cycle for the long haul. I won't say forever, but for the long haul, and in terms of the timeline in which you're planning for your business plans for the next 3 to 5 years or more.
Okay. You are tying right into what my last question to the three of you would be. So, Brad, if you would just add to your comments a little more illumination on what you think the state's best route forward might be in terms of how to utilize the CAT fund, and aside from the CAT fund, how to best stabilize the state financially in light of the storms that we face, in light of what we think our true storm risk is.
Thanks, Lori. So my last bite at the apple. So I think right-sizing, so-called the catastrophe fund, is the right thing to do via legislation. And right-sizing to me means the CAT fund stays, and the CAT fund stays in the way in which it funds for a 3 to 5 year period of time, a $10 billion or so layer that is there and reliable. And it's either funded by cash or it's funded by risk transfer products, but it doesn't need debt to survive for that 3 to 5 year period. And that provides truly a layer that everyone then can build for the long haul their business plans around. And then the private reinsurance markets add capacity up, down, around below that based on what their clients here in Florida want. I think all residual markets we know of buy reinsurance products and risk transfer products, whether it's the California Earthquake Authority or the Texas Wind Pool, and obviously Barry Gilway and Citizens have moved the goalposts in terms of what's available for residual markets based on their good work. I think arguably if the CAT fund buys its own reinsurance product, that sends a new price signal to the market on what reinsurers are willing to take in terms of risk from the CAT fund, which would be viewed by definition as the riskiest buyer of reinsurance in Florida. So if the CAT fund negotiates a rate, ceding insurers would come into their reinsurers and say, I want something below what the CAT fund just got. So that activity of the CAT fund could have a very positive impact on the market as well. So again, over the long haul, be careful financial stewards of your bonding capabilities. The National Flood Insurance Program is $24 billion in debt. Does anybody think that debt is sustainable? If it's not paid off, it means the taxpayers have written it off. The federal government can do that because it can print money. I mean, Florida can't issue $25 billion of catastrophe debt decade after decade after decade. So there's got to be careful financial stewardship, and I think what we've described in terms of right-sizing the CAT fund is a way to be careful stewards of the resources that Jack has very carefully and wisely managed over time, of course, with the oversight of the State Board of Administration.
Dennis, if you would respond to that.
I agree with a lot of what Brad said. I think, first off, I want to disagree with one thing that Jack said. Jack said that we aren't cognizant of politics. We are cognizant of politics. I was asked to opine about what the Florida would look like without the CAT fund. But politically, I don't think that the state of Florida will get rid of the CAT fund, certainly not within the medium term. If there are problems with the CAT fund that become, that exacerbate the problems that in the property market, perhaps there could be a phase out. But I just don't see that anytime soon. So what Florida needs to do is increase its resiliency in every way possible. So Florida has worked on building codes. They're good, but they're not as good as Bermuda. We could be stronger. We can avoid losses, and that's something we should do. The Florida CAT fund also needs to, the Florida state needs to increase its financial resiliency, and the CAT fund's part of that. So as Citizens, President Gilway's done a phenomenal job on reducing the exposure there and with his team, and we appreciate your business. Because the CAT fund's offering $17 billion year in and year out, regardless of how much cash it is, in one way the CAT fund's a cliff. When there aren't storms, like this point in time, the CAT fund's flush with cash and doesn't need to borrow. If there is a storm, the cash could go away immediately. So what do we want to do? I agree with what Brad said. We need to be looking at a 3 to 5 year time period. We need to reduce the exposure for Florida. We need to take advantage of risk transfer opportunities that exist. And we need to try to have some cash left over on a year-to-year basis instead of having all the cash exhausted in year one. How can we do that? Well, there's a whole bunch of ideas that are available to policymakers. They could buy reinsurance. The CAT fund could buy reinsurance. We could shrink the size that the CAT fund offers. We could make the top layers voluntary. And that's sort of right now everybody would buy the CAT fund because everybody expects the CAT fund to pay its losses. But what happens if it gets in a situation like it was in 2009, where we looked at the CAT fund, we said, gee, or the CAT fund looked at itself and said, gee, we're not going to be able to bond in a timely manner the amount that we are being asked to bond so we can pay all of our losses. So at that time period, in that crisis, if insurers were permitted to go out to the private market instead of having a mandatory, insurers, yes, instead of having a mandatory purchase from the CAT fund, when the CAT fund at that point could be the most expensive reinsurance. Because the most expensive reinsurance is the reinsurance that doesn't pay after a loss. So if we put the CAT fund in a situation where the CAT fund can't pay, that's bad for insurers. So we build in resilience by giving insurers the ability to purchase the reinsurance when it makes financial sense to them, the state of Florida, and their customers, or to purchase private reinsurance when it makes sense to them. Another opportunity is akin to the NFIP, where Congress puts a cap on the size of the debt. Florida policyholders or policymakers might consider putting a cap on the amount of debt that the CAT fund can issue, either on a per-year basis or on an aggregate basis, or any combination thereof. So there are things that can be done so you can manage the exposure of the state of Florida, its consumers, and its businesses to excessive debt and debt that will slow down the business cycle and the ability of the state to attract additional residents and businesses. One thing that we always are concerned about with the CAT fund is that it internalizes risk in the state of Florida. And everything that I've talked about thus far has been internalizing the policies that Florida could do looking inward. Florida could look outward as well. And I'm not talking about the Florida wish list of getting a national catastrophe fund. What Florida should be doing is helping reinsurers find other markets. We want to write earthquake risk. Why do Floridians have to have homeowners insurance, yet Californians don't have to have earthquake insurance? The way insurance works is insurers pool risk, try to evaluate their exposure, and bring in enough premium to pay for those losses out of the pooled premium. The concept is not to use your surplus or your capital. The concept is to use the premium to pay all the expected losses. So if we have additional opportunities to bring in capital from other risks, that will help Florida. If Californians had to purchase earthquake insurance the way Floridians have to buy homeowners insurance, Florida wouldn't be the peak zone anymore. People would want Florida risk to offset their California earthquake risk. So one thing that you could do is talk to your representatives and encourage them to require Californians to purchase earthquake insurance. The NFIP is another problem. They don't have the money. Reinsurers are looking for risk. We have more capital than we have risk. It's an enviable situation for the state of Florida. It's an enviable situation for the government of the United States. Encourage your elected representatives to push for the NFIP to transfer risk, to take it off your backs as taxpayers. If the government writes it off and prints money, that's the same thing as taxing you and your children and your grandchildren at the rate we're going, and perhaps a couple of generations thereafter. So the issue is, what should Florida do? Farmers always say the time to grow hay is when the sun is shining. Well, the sun is shining on the insurance market in the state of Florida. Take advantage of it. The state should look for its own properties. Municipalities should look for their own properties, and they should buy insurance and reinsurance and transfer risk to the maximum extent possible, because hurricanes will come, and they're going to come soon because we're already at a record time period without a hurricane. So the reinsurance markets are open. We want your business. We want the business from natural catastrophes anywhere. We will be here year in and year out. We have the ability to raise capital almost instantaneously, and we encourage you to take advantage of our competitive largesse at this point in time.
Thanks, Dennis. I'm going to let Jack have the last bite at that question since he lives the cat fund side of this day in and day out.
Well, I mean, I agree with a lot of things said about right-sizing the cat fund. I guess to me, right-sizing just means that we're capable of paying our claims sufficiently and timely. And that's all that's ever mattered with us. And we also want to be able to sustain the cat fund, because it's not just a one-storm wonder. It should be something that helps stabilize the economy and the market in the long run. There was legislation passed in 1999 that was intended to create subsequent season capacity. It capped the limit at $11 billion and increased the assessment percentage so you could have the ability to assess for a subsequent year. And then that was expanded in 2004. The limit was up to $15 billion. When it was originally put at 11, it was not meant to achieve 11. It was meant to cut off anything above that, so you had something that could be used for a subsequent season. So that was the whole idea with the limit, because the law had always said we're only obligated to do what we could do with cash and our ability to bond, which was capped, and it is capped at a 6% assessment on an annual basis. So you don't need to worry about capping the amount of bonding. That may already be capped by the marketplace. What we have capped is the assessment percentage. And we estimate our capacity twice a year. We estimate based on what we think we can raise within a 12-month time period as well as 2-year time period. But what's important for insurance companies is that we pay timely. We could have a $50 billion storm, and we could have companies that go through their cat fund coverage within 60 to 90 days. And then we should be able to pay those claims on a timely basis, as opposed to them going out of business while we're fiddling around trying to raise debt over a 2 or 3 year time period. So I think the biggest concern is looking at the cat fund from a financial mechanism that creates the additional capacity in the market, stabilize the market, as opposed to something used to lower rates, because that was the biggest mistake made in 2007 when the cat fund was expanded. Where it became, instead of a fund to stabilize the market, it was turned around so that it could have destabilized the market. We could have had a loss in 2009 that could have been about a $14.5 billion shortfall from what the industry was expecting, and so they wouldn't have had that coverage. So all the people that are concerned about the price of coverage will just figure out what our rate on line was in 2009 with, I can weekly say $13.2 billion. I say weekly because I'm counting the put option that wouldn't even have come into play till we had $16 billion of losses. So anyway, when you figure out that rate on line, it was pretty expensive reinsurance from that standpoint. So anyway, that's all my comment.
I think we have a couple of minutes left. If we had one question from the audience, I think we have time to entertain that. Or not? I think these guys did a great job covering a lot of ground in conversation. So I think if anyone does have a question later, I think all three gentlemen are planning to stay through most of today at least. So just nab them and ask them personally. And most of you know them, so I think that's what to do. That's everything for our panel. Thank you.